There's something most Americans over 62 do without thinking twice. They keep their savings in a bank account. It feels like the safest decision possible. The money is there, it's insured, it's earning interest, it's accessible. And for most of your working life, that instinct was correct. But here's what nobody told you when you crossed into retirement. 3 rules, one from the IRS, one from the FDIC, and one from Medicare, apply specifically to the way retirees hold money in savings accounts. And none of the 3 are explained by your bank when you open the account, when you deposit money, or when your balance crosses the thresholds that trigger them. Today I'm going to walk you through all 3, because the cost of not knowing them isn't theoretical. It shows up in your account, in your Medicare premium, and in some cases in a federal alert you never saw coming. Let's start with what most people think they know about the IRS and bank accounts. You've probably heard that banks report transactions over $10,000 to the IRS. That's true. It comes from something called the Bank Secrecy Act, which requires financial institutions to file what's called a currency transaction report for any cash transaction exceeding $10,000 in a single day. Most people hear this and think, fine, I'll just keep my transactions under $10,000 and there's nothing to worry about. And that's exactly where the first trap is. Because the IRS and the Financial Crimes Enforcement Network anticipated that reaction, and they created a separate category for it. It's called structuring. And structuring is when you break up transactions specifically to avoid the $10,000 reporting threshold. Here's what makes this dangerous for retirees. You don't have to intend to break the law for the pattern to trigger an alert. If you make several withdrawals of $8,000 or $9,500 or $7,200 over a short period, and the bank's monitoring system interprets those transactions as a deliberate attempt to stay under the threshold, they are required by law to file a suspicious activity report, not a currency transaction report. A suspicious activity report, which goes directly to federal financial intelligence and does not require them to notify you that it was filed. Think about the situations where this happens to retirees without any criminal intent whatsoever. You're paying for a home renovation in installments. You're helping an adult child with a down payment spread across a few transfers. You're covering medical expenses that arrive in separate bills from separate providers. You're moving money between accounts over several weeks because you're not sure exactly how much you'll need. Every one of those scenarios can produce a transaction pattern that looks, from the outside, like structuring. And in 2023 alone, American banks filed more than 4 million suspicious activity reports. The overwhelming majority of those did not involve criminal activity, but every single one of them involved a federal review process that the account holder never knew was happening until, in some cases, it had already escalated. I'm not telling you this to create fear. I'm telling you this because the solution is straightforward once you know the rule exists. If you need to move a large amount of money, paying a contractor, transferring savings, helping family, covering a medical expense, do it in a single transaction with clear documentation of what it's for. A check with a memo line, a wire transfer with a stated purpose, a receipt kept with your financial records. The IRS is not looking for retirees who are paying their bills. They are looking for patterns that suggest evasion. A single large transaction with a documented purpose does not look like evasion. A series of smaller transactions with no documented context sometimes does. Know the difference before you move money, not after. Now let's talk about the second risk, and this one has nothing to do with the IRS. It has to do with what happens to your money if your bank fails. The FDIC, the Federal Deposit Insurance Corporation, insures deposits up to $250,000 per depositor per bank. This is one of those facts that most Americans know in the same way they know their car needs oil changes. They know it exists, they're not sure of the details, and they assume it covers them. But here's the detail that matters. The $250,000 limit is per depositor per institution, not per account. If you have a checking account, a savings account, and a CD at the same bank, all 3 together are covered up to $250,000 combined, not $250,000 each. For someone who has spent 35 years working, saving, and building toward retirement, having more than $250,000 at a single bank is not unusual. It's actually common among people who did everything right. And every dollar above that $250,000 threshold is uninsured. If the bank fails, those dollars go into the FDIC's receivership process, which means they enter a legal and administrative queue that can take months or years to resolve. And that historically has returned cents on the dollar, not full value. We saw this play out in 2023 when Silicon Valley Bank, Signature Bank, and First Republic Bank all failed within weeks of each other. The FDIC stepped in and ultimately guaranteed deposits in those specific cases beyond the standard limit due to systemic risk concerns. But that was a discretionary decision made under extraordinary circumstances. It is not the rule. It is not guaranteed to happen the next time a regional bank fails. And regional banks do fail. There were 5 FDIC-supervised bank failures in 2024 alone. So what do you do with this information if you're sitting on more than $250,000 in savings? You distribute, not randomly, but strategically. The FDIC coverage rules have specific provisions that allow you to extend your protection significantly. Joint accounts are covered up to $250,000 per co-owner, which means a joint account held by 2 spouses has $500,000 in coverage at a single bank. Retirement accounts like IRAs are covered separately from regular deposit accounts, with their own $250,000 limit. Accounts held in trust with named beneficiaries have their own coverage calculations based on the number of beneficiaries. If you structure your deposits correctly across account types and institutions, a couple can have well over $1 million fully insured without moving money to dozens of different banks. But you have to know the rules to use them, and almost nobody explains them proactively. The third risk is the quietest of the 3. Because it doesn't arrive as a federal alert or a bank failure notice, it arrives as a line item on your Medicare statement that's slightly higher than you expected. And most people who see it never connect it back to their savings account. This is the IRMAA trap. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a surcharge added to your Medicare Part B and Part D premiums if your income exceeds certain thresholds. In 2025, the base threshold is $106,000 for individuals and $212,000 for married couples filing jointly. Below those numbers, you pay the standard Medicare premium. Above them, you pay more, significantly more. The surcharges are structured in tiers, and at the highest tier, the additional cost can reach $594 per month on top of your standard premium. That's over $7,000 per year in additional Medicare costs triggered purely by income level. Now here's the connection most retirees miss entirely. High-yield savings accounts are paying between 4% and 5% annually right now. That's genuinely attractive, and it makes financial sense to take advantage of it. But those interest earnings are taxable income. They show up on your 1099-INT at the end of the year, and they add directly to your adjusted gross income. For a retiree with $400,000 in a high-yield savings account earning 5%, that's $20,000 in additional taxable income every year. On its own, $20,000 may not seem significant, but it doesn't exist in isolation. It sits on top of your Social Security income, your pension, if you have one, your required minimum distributions from your IRA or 401k, any part-time work income, and any other investment distributions. And when you add all of those together, that $20,000 in savings interest might be exactly the amount that pushes your total income from $98,000 to $118,000, from below the IRMAA threshold to above it. The result is a Medicare premium increase that continues every month for the entire year with a 2-year look-back period, meaning the income you report this year determines your Medicare premium in 2 years. You make a financial decision today. You feel the Medicare consequence in 2027. Let me tell you about a couple that I want you to think about because their situation is more common than it sounds. They retired in the same year. Between them, they had $520,000 in savings, all of it at a single bank in 2 accounts. They had Social Security coming in, a small pension, and their savings were in a high-yield account earning around 4.8%. They were proud of the interest they were generating. It felt like their money was finally working for them after decades of working for it. Three things happened that year that they weren't prepared for. First, they made several large withdrawals over a 2-month period to pay for a kitchen renovation, each one just under $10,000 because the contractor preferred smaller payments for scheduling reasons. Their bank filed a suspicious activity report. They didn't know until 14 months later when they were contacted as part of a routine review. Nothing criminal was found, but the process was stressful, time-consuming, and completely avoidable. Second, when they looked closely at their FDIC coverage, they realized that $270,000 of their savings was uninsured because both accounts were in their individual names at the same institution. They redistributed immediately, but only after a conversation with a friend who happened to mention the $250,000 limit at a dinner. They had no idea. Third, the $24,960 in savings interest they earned that year, combined with their other income sources, pushed their joint income to $226,000, just over the second IRMA tier threshold. Their Medicare premiums increased by $230 per month each, $460 per month combined, beginning 2 years later. They're still paying that surcharge today. None of what happened to them was catastrophic. None of it was irreversible, but all of it was preventable. And all of it happened because 3 institutions, a bank, the FDIC, and Medicare, each operated correctly within their own rules, none of them looking at the full picture of that couple's financial life. That's not a criticism of those institutions. That's just how the system works. And when you understand how the system works, you can navigate it instead of being surprised by it. So here is what I want you to do after this video. 3 specific actions, not general advice. First, look at your current savings balance at every bank where you hold deposits. Add up all accounts at each institution separately. If any single institution holds more than $250,000 of your money in accounts under a single ownership structure, you have uninsured deposits. Contact the FDIC's website. They have a tool called EDIE, the Electronic Deposit Insurance Estimator, and run your actual account structure through it. It takes about 10 minutes and will tell you exactly how much of your money is covered and how much is not. Second, look back at your last 6 months of bank transactions. If you see a pattern of multiple transactions that are all just below $10,000 made within a short period, document the legitimate purpose for each one now, before you ever need to explain it. A simple note in a folder with receipts or records is enough. You are not doing anything wrong by having that documentation ready. You are doing something smart. Third, before the end of this year, add up every source of taxable income you expect to receive. Include your Social Security, 85% of it if your total income is above the threshold. Include your pension. Include your required minimum distributions. Include your savings interest. Add it all up and compare it to the IRM/AA thresholds for your filing status. If you are within $20,000 or $30,000 of a threshold, talk to a tax advisor about whether there are steps you can take this year to manage your recognized income before December 31st. Because the decision you make this year determines your Medicare premium in 2027, and that is a long time to pay for something that was preventable. Your bank account is not just a place where your money sits. After 62, it becomes part of a system that connects to the IRS, to the FDIC's insurance architecture, and to your Medicare premium calculation in ways that are real, consequential, and almost never explained in the same conversation. The 3 rules we walked through today, the structuring trap, the FDIC coverage limit, and the IRMAA connection, are not obscure technicalities. They are the rules that govern how your retirement savings interact with the federal systems that surround them. You have spent decades building that savings. Understanding the rules that apply to it now is not optional. It's the next part of the same work.